Hello and welcome to another episode of the Consumer Credit Matters podcast. I'm your host, William Black, and today we're going to talk about Tricolor. Tricolor is a subprime auto lender that filed for bankruptcy, Chapter 7 liquidation bankruptcy, less than a month ago. And what is unfolding is likely to be one for the record book, certainly in terms of consumer credit securitizers, where we have allegations of double pledging or fraud. We have a trustee who's already signaled that they intend to resign in their role for these securitizations. We have massive downgrades from all the rating agencies who had rated some of the top classes in the top rating categories, all the way down to very, very low ratings. We have a backup servicer who's now moving into place under this situation of duress and trying to pick up the pieces and see if they can keep the music playing with respect to cash flows to investors. By the way, even missed payments now alleged to have taken place to investors in the month of September. A lot unfolding still. This is a real-time discussion that I have with my very special guest, Rod Dubitsky. Rod and I go back with a brief intersection many, many years ago at Moody's. And Rod has since been, well, he's worn many hats, as you'll hear, but he's most recently been posting very actively on LinkedIn around on this topic, of course, and many other consumer credit topics. So he fits right in the lane of the Consumer Credit Matters podcast. I really enjoyed my time with him. He was very, very generous with his views on a situation that is still unfolding, and we don't have all the facts for sure, but I do think a conversation about where things might land and where the risk is and the implications for the broader subprime auto lending industry are all instructive. I hope you join us for this conversation, and thank you. Rod Dubitsky, welcome to Consumer Credit Matters podcast. How you doing?
Good. How you doing, Will? Thanks for having me.
My pleasure. Really looking forward to our conversation today, and I think listeners are in for a really interesting conversation. We're going to be talking about a company called Tricolor, or some people pronounce it Tricolor. This is a subprime auto finance company that has, let's say, blown up in spectacular fashion, to put it in dramatic terms. But very recently, I think September 10th, went straight into Chapter 7 bankruptcy, and under a cloud of pretty damning allegations around fraud, double pledging, and in the ensuing days and weeks, we've seen massive downgrades by all the rating agencies that rated their securitized debt. We've seen wholesale lenders publicly announce that they're taking hundreds of millions of dollar write-downs immediately or nearly immediately from the Chapter 7 announcement. And the very unusual move here, the trustee on the transactions, Wilmington Trust, has announced their resignation from those transactions, which is also a pretty big deal. And we have, of course, as belts and suspenders to any securitization, a backup servicer in place that has come into the picture as well. And we'll talk about, what they must be facing coming into this mess as the backup servicer. And I should say also that we're going to be doing a little bit of speculation here, maybe a lot of bit of speculation here, because the facts are unfolding in real time. And we're piecing together those facts that have been disclosed in broad media or other sources of information. But we're going to hopefully weave that together with our collective experience in looking at, unfortunately, other, similar circumstances over the last 20, 30 years. Thankfully, the list is relatively short for these types of, disasters in the making. But what can we learn from that and share with our audience about how, in this case, a subprime auto lender can get into real financial trouble very, very quickly, and what that means for, what it means for the whole ecosystem, what it means for warehouse lenders, what it means for securitizers, securitized investors, ABS investors, what it means for subprime auto and auto lending and consumer lending in general. I think it really has knock-on effects to all of those sectors that I think we're going to get a chance to go through in some level of detail. But Rod, before we get into that detail, I wanted to let folks know. I mean, we've known each other for a very long time. I think we crossed paths for a pretty short period of time way back when at Moody's. We were both at Moody's. It was more than 20 years ago, right? I hate to say it out loud, but since then, I've seen you very active on LinkedIn. I know you are you go under the moniker of the People's Economist, and you post quite actively on any variety of topics as they pertain to finance. And lately, you've been posting a lot of great information on the Tricolor situation, and that's one of the reasons I wanted to have you on as a guest today, because I think you have a lot of interesting perspective to share with our audience. So with that, why don't you introduce yourself a little bit, and we'll get right into it.
Sure. Thanks again, Will, for having me. So basically, my interest in Tricolor has come from various aspects of my background. So I had most of my career on Wall Street, 25 years or so. As you mentioned, three of them working as a securitization analyst for Moody's on the residential mortgage-backed securities. And I saw problems with securitization as far back as 2000 when I left Moody's. Then went to Credit Suisse, and I was the subprime mortgage analyst during the financial crisis. So that gave me a profound understanding and fear of financial bubbles. And that was not my first bubble that I went through. I was a savings and loan examiner during the savings and loan crisis some 10 years or so earlier. And and so I've been through two of the largest financial bubbles, in my lifetime. And my first day on Wall Street was 1987, the Great Crash. My career has been sort of
The greatest hits.
the greatest hits of financial crises and crashes. And so I guess I would, and the People's Economist is a merger of the Economist magazine, which I like and respect and covers a lot more than economics, and the People's History of the U.S. by Howard Zinn. And I kind of join those up together. And my company is the People's Economist, and I provide a lot of consumer related tools, including debt calculators, portfolio valuation tools, dashboards like fixed income. So I basically called Bloomberg for the masses. So my background at Credit Suisse, because it included a deep dive on subprime mortgages and consumer ABS, including credit cards, auto, student loans, I provide a lot of those tools to consumers, but also I focus a lot of that in terms of my my research. And I'm like a bubble chaser. I'm trying to find out where the next financial crisis is coming from. I've been looking at a lot of the private credit, private equity, commercial mortgage-backed security space. And when the news hit on Tricolor, and I saw what seemed to be an unprecedented situation unfolding, a company that has securitized $1 billion just going out of business, shutting down. Literally, they furloughed the entire staff prior to the Chapter 7. I said, I've never seen this before. This bears watching, and I jumped into it right away. And then I've kind of been covering that, as well as there's been another auto-related bankruptcy first brands that I've been covering. So mostly what I do is build my platform for consumers, but also do sort of my old style Credit Suisse type of institutional research.
Got it. Thank you for that. That's great. And why don't we pick up on exactly that kind of incident, this Chapter 7 filing, that, it's a good place to start, because it's unusual for any company to file Chapter 7 as the first kind of as the first move to protect themselves from creditors. Usually you see a company get into trouble. There are some smoke signals ahead of time. I don't think we had any, or at least not to my knowledge, smoke signals in this case that said Chapter 7 was near. And usually companies will file Chapter 11 for reorganization, restructuring their credit or their, with their debt with their creditors. Didn't happen in this case. What's your first impression now that we have a couple of weeks behind that Chapter 7 filing with what happened, what went wrong?
Yeah, have a theory. I had a theory, and given the more and more evidence of the pervasiveness of fraud, I'm not sure if that theory is right. But my view is that what happened is they, because of their client base was, depending on the data I've looked at, it's up to 70% undocumented. And because of what's happened with the immigration policy, their entire customer base was vulnerable. So I think there was a double collapse in payments on their existing auto loans and a collapse in their sales. And they Tricolor is a bit unique. There are a few like them, but they owned all their own dealerships. They were financing all of their own loans. So they were completely vertically integrated. And when they saw the collapse on the sales side, they saw the collapse on the borrower side. Maybe out of in desperation, they started double and triple pledging loans and vehicles. And I don't know what the tripwire was to cause it, but 2 days before the bankruptcy, they basically furloughed and shut down completely. Uh, I had read that a bank took them over. I'm not sure which bank. Fifth Third was the first to announce that they were writing off their entire warehouse line. And when I saw that, I thought, well, if you have a 200 million warehouse line and you're writing it off, it's a lot more than just double pledging loans. There's something deeply pervasive going on.
Yeah.
Because normally you would try to have an estimate, and then so I knew that something was up, and more information that's come out has confirmed that it's a vast and widespread fraud. Whether it was triggered by the immigration policy impacting business and then the fraud happened, or whether there was fraud all along, I'm not sure at this point.
So let's talk a little bit about, I want to take a quick step back because I think it's important to understand what Tricolor's niche is in the market and how they are different. You mentioned one of the aspects of their business model already, you mentioned a few characteristics of their business model that make them a little bit unique. One is we're not talking about a giant operation like a Carvana or a CarMax here. We're talking about a regional player headquartered in Texas and certainly concentrations in that region of the country in terms of the loans, in terms of the clientele. Second point is, as you mentioned, they are vertically integrated. That's not unique to them, but it is less common business model to have. And what we mean by that, listeners, is they are not only the lender, the finance company that will make the loan to their obligors, but they also own the dealerships. So they're selling the cars and providing the credit. You can imagine that there is a potential conflict of interest in that arrangement, right? If you want to juice sales, then you can relax credit. If you want, and if you need to tighten credit, well, there's going to be an implication to your sales in all likelihood. That is not an impossible conflict of interest or possible conflict of interest to overcome. So I'm not trying to damn the business model as a whole, but it certainly raises more questions around some of that tension that lies there. They are also, as you mentioned, focused on the Hispanic population in that region of the country. What I've seen in media accounts of their business profiles that they do have some large proportion of, you call them undocumented workers. Is that right? So I don't think that either one of us has, the can be an oracle of truth around the that particular statistic, but that's certainly what is being bandied about in the press right now, and that then makes them potentially vulnerable to some of the policy shifts that have been taking place throughout the country. So that may also be at play. Not to mention the fact that they are close to the border, close to the Mexican border, and I know that that's also a concern about borrowers who can flee uh, or evade uh, uh, repo or collection efforts more easily because they can cross the border relatively easily. Again, we don't know that that's happening, but that is certainly one of the questions that has been put out there, and it's a logical question to ask, I think,
Yeah.
given their clientele.
I posted two things Thursday and Friday that added some more color, and these have been not validated by the bankruptcy trust filings. And so, in one story, they talked about 30,000 repoed cars, and they had 100,000 loans. So a third of their entire portfolio, the cars were missing that they were trying to repossess.
Uh-huh.
So that suggests when they're missing, and supposedly they were all tagged with GPS monitors, but those probably could be disabled. But that 30,000 missing vehicle number suggests that perhaps is one thing I had thought all along is that those consumers faced with the risk of forced detention decided to self-deport over the border, and their single biggest asset was their car. And if once you drive it over the border, you now have a asset without a loan attached because collecting in Mexico probably is difficult, if not expensive. So I think, and this is a bit of speculation and confirmed by 30,000 missing vehicles, that there was a lot of self-deportation, including with the vehicle.
Right. Another thing about this company's profile that makes it a little bit different, they are non-prime, deep subprime. They're not just subprime; they're deep subprime, right? So these are subprime of a different order. For those who had a FICO, and many did not have a FICO, large proportion did not have a FICO, as I've read. The average FICO was somewhere around 550, which is very, very low. Usually, so-called subprime originators are closer to the 660 mark, or at least 600 mark even. But 550 is quite low. And so the other thing is that the corporate entity, as far as I know, was not rated.
Right. I don't know of any rating on it.
I don't know if anyone rated the corporate entity. And again, we'll talk about some of the other companies that play in this space and what their corporate ratings are. But that, I think, is a difference as well in terms of how and why they finance themselves the way they did. So actually, that's probably a good segue to talk about the next aspect of their business profile that is going to be, I think, relevant for this conversation. And they were wholly dependent upon wholesale funding and securitization. So they had warehouse lines of credit. These are secured financings, not the same thing as securitizations, and that's a distinction with an important difference, as we'll, I'm sure, talk about. And then they had, for several years now, issued a term ABS, term fixed income securities, backed by these auto loans. Again, a program that has been up and running for many, many years, rated by S&P, Moody's, and
KBRA.
and KBRA, Kroll. So and as we'll talk about, rated very highly, those bonds, or they were, because those bond ratings have come down to basement levels now. So we'll get into that. But they had several $100 million in warehouse financing, and I think you said approximately $1 billion. Is that outstanding on the
Outstanding,
ABS?
yeah. Like 950 million of it is remaining outstanding.
Yeah, so a lot of ABS outstanding. I understand they also had some intersection with ABCP conduits. I've read about that as well. And we'll talk about, again, some of the differences in exposures and risks.
Another important aspect, because they were vertically integrated, is if you look at the Chapter 7 filings, a lot of their creditors were floor plan lenders. So the floor plan lender is providing the loans to the vehicles. So the pipeline is floor plan loan finances the vehicle, warehouse line finances the consumer auto loan until it's securitized in a securitization. So somewhere that vehicle may have had three owners: the floor plan lender, the
Hmm.
warehouse lender, and the securitization vehicle.
And this is the thing I think is worth going into. Again, we're off in the world of speculation here because we don't know whether double pledging was involved, but it certainly has been alleged. And it would certainly be a reasonable conclusion based on the evidence that we have, and the behavior of lenders so far, not to mention the Tricolor themselves. So let's work with that assumption for the moment. And I want to describe for listeners how double pledging might happen under these circumstances. Because, when you're lending hundreds of millions of dollars to a company, you're typically going to want to have some, and you're doing that based on underlying assets. You're going to want to have some evidence that you have rights to those assets. And there's a legal process that these lenders follow to protect themselves. You file UCC, what are called UCC ones, but you basically put on a notice everybody participating in the UCC system, basically, that you have a first lien claim on the assets. The assets we're talking about here are the loans, legally speaking, called chattel paper, and that's a distinction with a important difference here that we're going to get into when we start talking about the trustee's role and custodial roles, I should say. But before we get into that, you file a UCC1 and you say, look, I have a claim on this contract, and you're providing financing and you feel better about your arrangement because you have a clear legal claim. This is evidenced by opinions and the filings that I mentioned. Now, that's what happens on the wholesale lending lines. But eventually those are typically thought of as temporary lines holding the collateral until you have enough critical mass to then securitize in the term world. Then you have to do something that is very important. You have to file a UCC3 to let the world know that that you've now sold that receivable onto another party. You have to say, I release my UCC1. I do that by filing UCC3. And then the new lender in this example would be, let's just say, the ABS SPV. The ABS mechanics would file a new UCC1 and claim first priority on those contracts. So that's really important. You have to file the UCC1, and you also have to file the UCC3 to relinquish your first priority claim. If you don't file the UCC3, or there's some sloppy paperwork, or it's just not done right, the UCC3 never takes effect, and you could have a situation where you have more than one party claiming priority. So now you have two companies, two lenders who have filed UCC1s, and those competing claims now need to be fleshed out, and that's not an easy thing to do. We can talk about how that might be done, but it's going to take a long legal process to fully adjudicate any competing claims on those collaterals. Go ahead, Rod. I may have interrupted.
Well, that's an interesting. So if you take the warehouse lines, and we know there's Barclays, Fifth Third, J.P. Morgan. There was a smaller bank, Triumph, that was part of that. And I know from the filings, as you suggested, Wilmington Trust filed on behalf of warehouse lenders, including the hedge fund Libramax was named. Now, the question is, were they the custodian for all the warehouse lenders, or were all these lenders going independent and therefore more vulnerable to double pledging because they didn't have a single sort of custodian making sure that there wasn't double, triple pledging? There was no lead warehouse lender. Maybe the trustee, Wilmington, was that coordinating, and maybe that's partially why they resigned, because of their dual role as warehouse custodian and securitization indenture trustee, they said, well, I don't know why they resigned. It's another thing I think you mentioned is unprecedented, but it may be their role as warehouse lender somehow put them in conflict with their role as indenture trustee. And then who was taking care of the other bank warehouse lines? Was it Wilmington, or was it were they self sort of custodying or self being their own validation of the collateral?
I don't know. Look, I don't want to go far out on the speculation branch for this one, because you and I both know Wilmington Trust is at the top of their game when it comes to being a trustee and reputationally, and their presence in the marketplace. And they have been called into action on probably countless other transactions, not with this much hair on it, perhaps, but there have been some ugly situations that they've worked through. They have a lot of collective experience at that shop, for sure. I would be very surprised if they entered in day one into an arrangement that they could have foreseen putting themselves into a conflict of interest. More likely explanation in my mind is that they resigned as trustee as a way to minimize or mitigate what they foresee being a very litigious environment. And so the sooner they can extricate themselves from that, the less exposure they have going forward. That doesn't mean they extricate themselves from anything that's happened up to date. And by the way, it's an important point to point out to listeners that they have indeed announced their resignation as trustee, but they can't step away from their responsibilities instantly. In fact, they have to stick around until a credible trustee has been found to replace them. So those important responsibilities that the trustee undertakes for securitizers and or warehouse lenders remains until they find a replacement.
Yeah.
So I don't know, and you also pointed out something else that I think is interesting, a differentiator between the warehouse lending arrangement and the ABS. The warehouse lending arrangement has many participants oftentimes, and it sounds like they do in this case as well. And so there can be, we don't know in this case, but there can be a diffusion of responsibility around tracking, the receivables or the contracts in this case. And that might be a point of vulnerability in this case. We just don't know, but it is interesting that the first sign of trouble from any of the lenders is coming from a warehouse lender. You mentioned Fifth Third. I think their CEO announced that they were going to write off up to the entire exposure of $200 million, which is pretty dramatic. Yeah, right.
Yeah. And that's why it suggested early on that the fraud was more than just triple pledging of a few of a few loans. And I think it's important to, because it's the indenture trustee role. Like, I think, as you said, one of the reasons might be because of the complexity and legality of it, but that's kind of what a trustee signs up for when they're acting on this. When they get paid a little fee, occasionally things blow up, and then they have to get involved. They are generally indemnified from a lot of risk, and they can recover expenses. So some of this increased cost would not necessarily be borne by them. But and I had seen separately they mentioned in Wilmington Trust's role in validating the title of the vehicles, which I was surprised, because I wouldn't think an indenture trustee would do that. But it points to, in this entire value chain, was it the case of all of the players looking at somebody else like, well, it's rated, there's an indenture trustee, there are reputable lenders involved, JP Morgan, Barclays, Fifth Third. And the problem is at the back of it, controlling everything, was a completely vertically integrated company doing their own servicing, selling the vehicles. And I think there wasn't enough paid attention to uh, the parts of the operation that weren't directly overseen by all of these other sort of blue chip organizations. And I think from a governance standpoint, this is a lesson for, and there have been many in the history of securitization. There's a governance lesson for securitizations in general. And I don't think this will be the last we'll see in subprime auto in general, because there are a lot of other subprime auto companies, and we're seeing increasing delinquencies and deteriorating performance. None of them had exactly this business model, so I don't think you can superimpose Tricolor on any of the others. None of the others are have this kind of model exactly, but some of them approximate it to the standpoint where there should be caution,
Hmm.
and hopefully rating agencies, third parties will tap the warehouse lenders risk team on say, I want to know all our warehouse uh, lending lines. I want to know how we're making sure this isn't happening, who's controlling it. And that might lead to a crackdown or reduction in warehouse lending availability. And that itself could trigger some adverse implications as credit becomes less available, as risk managers decide that warehouse lending isn't as vanilla as we thought. And I think, as you mentioned earlier, some of these warehouse lines are in commercial paper, asset-backed commercial paper conduits. Sheffield is one which is managed by Barclays and guaranteed by Barclays. So there could be some losses Barclays faces as warehouse lender, but also putting some of the warehouse lines into their conduit.
I do want to get into the broader implications of this incident to subprime auto and consumer credit in a moment, but I don't want to leave Tricolor too quickly because uh, let's start talking a little bit about the securitized arrangement here and the ratings. I guess firstly, you mentioned Sheffield ABCP Conduit. If they had any exposure, I think it's fair to say with a fair amount of confidence that ABCP investors are shielded from these losses to a high degree. It is Barclays or the sponsor bank in any of these so-called fully supported ABCP programs that will take on any losses that may evolve from this situation. So that's a protection afforded by the liquidity facility that backstops these ABC programs. Not to get into too much technical detail there. The other thing that protects not only ABCP investors but also ABS term investors is another legal maneuver that is taken that again further insulates these securitized investors from the credit or the creditors of Tricolor in this case, but the originator, and that is a true sale arrangement. So you not only do you have the filings that we already walked through, the UCC1 filings, but in you've also taken steps to achieve a legal true sale, which further separates and protects investors from other creditors trying to compete for those same collateral that are backing the fixed income securities that are rated.
I mean, that is 99 times out of 100 the case. I think here what we're seeing in terms of the degree of fraud, some of the creditors who are not ABS might argue hopeless entanglement of the loans in the true sale and the credits, whether it's dealer floor plan or warehouse that are not in the ABS, and they may try to force a consolidation of the, because I'm not sure how the ABS, at first it looked like it was, well, this is a warehouse lending problem. Probably the term ABS don't have the double triple pledging, but it appears so pervasive now that in order for the ABS to perfect their interest and to benefit from the true sale, they have to be able to identify isolated assets that they can claim are theirs. When you have hopelessly entangled floor plan loans and then warehouse loans and inability to identify who owns the vehicle, who owns the loan, it may be that normal true sale protection for ABS holders falls away. I don't know if I haven't seen that, but I think if there's ever been a case for a risk where the true sale is disregarded or challenged, this could be one of those cases. Most
Right.
cases, it's not an issue. I agree with you, but this is one where I'm not 100% confident that the true sale will not be subject to legal challenges. And I'm not you might be a lawyer. I don't know. I'm not a lawyer. I don't know exactly the nature of the the challenge that would have to tear down that true sale opinion, but I think it's a risk.
Yeah, I agree with you. It would be highly unusual. It would be. This is already a situation for the record books. This is one of those incidents that people in the industry are going to be pointing to probably for decades to come as a cautionary tale of what could go wrong. If true sale is brought into question, then it will go straight to the top of the list because this is at the heart of securitization. So I would like to believe that that is bulletproof, but there's nothing bulletproof in any of these transactions. There are things that are, highly improbable, but they're not bulletproof. So I guess we'll have to stay tuned to see how the facts unfold to see, what legal course and challenges are taken. But let's get back to, the ratings and the ABS, because what we saw was, the senior classes of these ABS were rated by some rating agencies AAA, other rating agencies AA, other rating agencies only got to single A. We're going to talk about why that might be in a moment. But I believe all of them have now downgraded them to the maybe not to the basement bottom rating category, but awfully close. Probably that's due to a couple of things. As I have read the press releases from these agencies, one being the allegations of fraud, of course, coming from the wholesale lenders. The timely payment of interest is an important aspect of all of the rating agencies' methodologies. And my understanding from reading press accounts is that the September bond payment was in fact made, but then shortly after was clawed back. Again, just add that to the list of highly unusual aspects of this situation. I haven't heard of that happening before. And so that speaks to, I guess, confusion and already in these early days, competing interests for these cash flows. Once you miss a promised timely payment of interest, I don't, profess to know every rating agency methodology down to the letter, but that pretty much forces your hand to downgrade severely from anything investment grade to well below investment grade, as the case is. I know, for example, Moody's had the senior bonds rated at A1, which is pretty high rating. It's not AA or AAA, but very high rating, investment grade, squarely in the investment grade. And after this news broke, in a couple of steps, took those ratings down to B1 with, still the warning that they could be downgraded further. Now, these are the top of the stack class of bonds that have, I believe, over 50% credit enhancement behind them. All right. So you just have to, again, imagine what they are, any of these rating agencies are either in the know of or are forecasting now with this new information. And I'll say this in defense of all of the rating agencies in this situation, because we've talked a lot about the allegations of fraud. Any rating agency, and this is, I think, a very reasonable claim, will tell you that they don't rate to fraud. And here's an example, why you can't. You set up a system that is tried and true with lots of belts and suspenders and oversight, or a system is set up to create this kind of oversight and belts and suspenders and legal certainty. And there are still places where fraud could occur. And, it goes back to if there is a person or people who want to defraud you and are hell-bent on defrauding you, they can find a way, even with all of the, the rules, regulations, laws, processes in place around this highly mature form of financing, it can still happen. And rating to that aspect is just, it's, think about it just intellectually, it's impossible. So I can see why it's kind of carved out. Now, that's not to say that the rating agencies or anyone shouldn't be aware of heightened operational risk when it comes to issuers like Tricolor, who do have on day one, when cash was flowing, have heightened operational risk for some of the reasons that we've already talked about.
So going back to your point, I think KBRA took almost every senior rating, everything formerly AAA, took it directly to double C, other than some of the earlier ones that had delevered somewhat, took to triple C, which is sort of unprecedented. They're the only ones, I think, as we mentioned earlier, KBRA, the only ones who got to AAA, but still S&P only rated their last deal and got to AA, which is still almost risk-free. And I agree, the rating agencies have never put in their responsibility to do fraud detection or extensive due diligence. They rely on third parties. But in this case, they often would, I don't know how universal it is, if you have a company serving so many roles, doing an on-site servicer review, visiting some of the dealerships, visiting headquarters. I know I did that myself when I was at Moody's. I have responsibility of issuers, and I would visit them. I think we'd have to do due diligence reviews once a year, if our memory serves. So I would question whether KBRA or S&P, who rated the recent deals, ever did any operational review, particularly when in June we knew exactly what was going to happen with immigration, where the risk was highest. And I'm not sure, I don't remember from S&P's pre-sale report, which is very detailed, whether they did any on-site reviews. And that is something that they do. They don't, again, I agree with you, they don't do due diligence, or they're not supposed to detect fraud. They rely on third-party processes, as you eloquently described, in terms of how the securitization happens. They rely on, the trustee. They rely on the bankers who are bringing the deal. There's some amount of trust they place, and you can't expect them to detect fraud. In this case, they could have done more. And I think when you look at 60% of the loans being in Texas, 60, 70% of the loans, and there's some data, not speculation, that 60, 70% of their borrowers were undocumented. You could say, is this something that is securitizable? Is there such a degree of correlation among these 10,000 or 5 to 10,000 borrowers? Is there such a high degree of correlation geographically, economically, event risk-wise, that renders this not an ideal pool? Like, sometimes you say this isn't securitizable. In my view, I've published about single asset commercial mortgage-backed securities that shouldn't be AAA. So I do think you can take them to task for looking at assigning such high ratings, especially in June. And if you look at the performance of Tricolor, even without the political events, their cumulative defaults were 50, 60%. And this was a company that was supposed to meet ESG targets. We didn't mention it, but I don't know if it's maybe we'll talk about going forward, but BlackRock put 90 million into them as an ESG investment because they were serving an underserved community. Well, if you're serving an underserved community, a product that they default on half of the time, to me, that's not that meets nobody's social goals. It's not a product. And I think that partially was the mystique with Tricolor. They were viewed more than the other subprime lenders as being a noble member of the subprime auto lending industry. And I think that might have provided some cover to the players. Said, well, BlackRock put 90 million into them. So
I have to say, my reaction is, look, that narrative hangs together if you believe that the root cause or the genesis was the administration's crackdown on immigration. I'm not so sure personally. Whether that event occurred or not, there has been a very long now years long degradation in uh, certain pockets of the economy of households, regardless of where they live or who they are. And we've seen delinquencies year over year cascade upward. And so this so-called K-shaped economy that we're in, where we have kind of the tale of two cities around the haves and the have-nots, has been worsening for the cohort of borrowers who have not. And so what may have appeared to be a perfectly reasonable basis for analysis, and we'll go back to ratings where they were on day one, where interests were aligned. We all know that hardship, stress can cause those interests to become misaligned. And so it is also possible. I'm not taking away from your narrative. That's fine. But there is another narrative out there that this was just plain and simple. Again, if the allegations of double pledging are true, is just where the company's business model fell under such duress that either deliberately or through just sloppiness, seems kind of hard to believe, but one of those two would explain how double pledging could occur. And yes, these things tend to occur when business models are under stress, of course, right? They don't tend to happen when things are going well. And things have been getting harder and harder for these companies, for sure.
And I think you're right. I think there was some independent of policy change, and as I had mentioned, when their loans, half of them historically defaulted, those were already distressed borrowers in any political regime. So
Right.
what happened may have been inevitable. I do think the timing of their implosion coinciding with the crackdown immigration probably is not a coincidence. Was it the tipping point, or was it 10, 20% of the drive, or 5%? I don't know. And we won't know until the case is fully revealed. But I agree with you in general that the subprime auto is a loan to the have-nots. And in previous conversations, I had talked about the stretched underwriting of auto loans, and I focus on the term of the auto loan. And I looked at some data back in 2012. Most auto loans, I'm talking about generally, not subprime, were 5 years. Or 60 months, and that average has gone up to 66 months. So what that means is half the loans are 72 months now. And it may not sound like a lot, but when you have a depreciating vehicle and you want to sell that vehicle before your loan matures and you go to the dealer, you will have an underwater loan. In order for you to trade that vehicle in, you have to pay off that loan, the
Right.
deficit, or that lender, and this is where Tricolor comes in, that dealer has to give you a loan that covers your prior deficit. So that new loan becomes inflated. The new vehicle price is inflated. And with Tricolor, if a borrower defaulted and they had that underwater equity, they may have gone into a Tricolor dealership and say, well, we have to make a new loan equal to the old loan or close to it to minimize losses, which meant that vehicle price was inflated. So because of the stretching of the loan terms and the already high interest rate in subprime, these borrowers are paying, a substantially higher price for that vehicle than they would if they paid in cash. Some of it is justifiable because they are subprime borrowers; they are the have-nots. But some of it is just you wonder whether it's the system is inducing them into a transaction that maybe they'd be better off just finding an alternative. And I do think the term stretching has slowed down the default curve, so that as high as defaults are and
Mm-hmm.
losses are high, I think stretching the term from 60 to 72 to 84 months has slowed down the default curve because it keeps payments initially lower. But eventually that negative equity is building to a much greater degree, and that chicken will come home to roost at some point, either in loss severity or the borrowers will walk away because they realize how badly underwater their loan is versus the value of the vehicle. And then as a separate matter, how are these loans being serviced? Loan extensions are another issue that are keeping the lid on the volume of non-performing loans. And I'm looking at this for a number of subprime issuers. And that's an issue across subprime space and maybe even prime space, where you look at top line delinquencies and it's still high, but maybe it's would be much higher if these loan extensions, which add to the loan term and allow a borrower to cure a delinquent loan to cure, whether that's adding a lot to the stress. And we just don't see it because it's not well reported. There's some data reported, but it's not included in the delinquency numbers.
I've been watching that as well, the extension, and that's something to keep an eye on for sure. You know, an extension, just again for listeners, is, you know, what it might be self-explanatory, but I'll explain it anyway. You know, you're falling behind, or you think you might fall behind. You call up your lender and say, you know, can I stretch out my loan repayment term and lower the monthly payment, right? That's what you're talking about here, or
Right, or add missed payments onto the end so that your loans are
more likely is more adding missed payments onto the end. I think that's probably the more likely the case. So that is in essence a bet on if the lender grants an extension, then it masks the true duress that borrower is under, because then they're not reported as a delinquent borrower, or they don't progress in the delinquency buckets. And so it is a bet that the borrower is in fact going to get back on their feet and continue to repay to the end. But that may not happen. A good example was during the pandemic. Some issuers took this tack of allowing for deferment or extensions. Some of them embraced that strategy to a very high degree. It turned out it was a risk, right? We didn't know how the pandemic was going to turn out. We didn't know that the relief that the government provided would in fact be as much or as directly, helpful as it was. But at the moment, in the moment, it was a bet that the pandemic was going to be temporary and the borrowers would get back on their feet. It turned out to be the right call, is what I'm trying to say in that case. Yeah. It's not so clear. It wasn't clear then. It's clear in hindsight. It's not so clear in this case that a rising extension behavior is going to be looked back on as the right risk reward decision on the part of the lenders. So we'll see. So something to keep an eye on. But I agree. The lengthening of terms is another thing to keep your eye on. Generally speaking, at least in the data that I see for securitizers that file their data publicly on the SEC, loan terms are not getting longer not appreciably longer for the loans that they're putting in their securitizations. So they can manage, some people use the word cherry pick the term of the loans or the credit quality of the loans that they put in their securitizations for purposes of managing consistent collateral profiles for investors or their own issuance distributions. So that is something, at least that I've noticed among those that have public filings. It may be different for some of the called private 144A transactions, where at least there's been a handful of longer terms being employed. To your point.
Yeah, I think it depends on the set. Like in aggregate, it's happening, and individual subprime issuers, it's happening, and also on the prime side. And over the 10-year horizon, which I'm looking at, it's happening more pervasive. If you looked at the last few years, a lot of that lengthening happened maybe 5 years ago or longer. So depending on the time horizon, which subprime or prime auto issuer you're looking at, but there's definitely in aggregate in the auto sector. And this is an ecosystem, right? You've got dealership economics, which are going to impact how things go. And we didn't talk about the impact of the dealership on Tricolor, right? All those borrowers were reliant on all those dealers, some to pay in person, some for service, or many for service. And now all those dealerships have gone away. So your value proposition being a Tricolor borrower, even if you were a good paying borrower, has now significantly diminished. And telescoping that to the entire auto industry, the auto dealership economics are understripped. That whole model will then have an impact on the auto lending ecosystem. We don't want to go down that rabbit hole, but I think it's important to keep, the entire chain in focus when considering the risks of what we're talking about mostly here is auto lending, consumer
Yeah,
auto loans.
they're getting hit on both the willingness and ability quotient of the lending equation. Their ability was always, somewhat diminished relative to prime borrowers. I'm talking about Tricolor's average borrower. But now you're saying that their willingness might be diminished as well because the value proposition in terms of their relationship with the dealerships is no longer it no longer exists. Having said that, I mean, auto loans are hell or high water loans. We all know that, right? If you buy a car and you total it the next day, you still owe the lender whatever it was. Even if I won't say there are lemon laws out there, but even if it turns out that you have a recall, we've seen that at countless times. A airbag situation or a emissions scandal or what. There's been so many massive recalls by various OEMs who have finance companies. You still have to make your monthly payment
Uh,
regardless.
Yeah, I think you bring up an important point that isn't really talked about much. And if you look at some of these remittance reports, they have a line item called deficiency judgments. So I talked about the negative equity most subprime borrowers have in their loan. If their vehicle is worth 20,000 and they have a 30,000 loan, they still owe that 30,000, even if short of bankruptcy, if they were to get their car repossessed, the lender can come after them for that negative equity. So to your point on hell or high water, you can't just say, well, I owe the maximum of my loan or my car value. You're still on the hook for that. Short of filing bankruptcy, where you can get that deficiency potentially discharged.
Mhm.
But that's another reason that borrowers might keep paying, because they know that simply walking away from the car and handing the keys back in doesn't necessarily relieve them from that deficit amount. So that kind of keeps the incentive
Right.
from being purely a transactional. Well, am I underwater? Here are the keys. Plus, you need to keep borrowing. You don't want to trash your credit. Although at 550 FICO or 600 FICO, I'm not sure there's much downside in.
Gotcha. So let's talk about another important third party to these securitization transactions, and that is the role of the backup servicer. We haven't talked about that. In this case, it's Vervent. Just so happens that I had a podcast with some senior officers from Vervent a couple of months ago. Um, we covered their role in situations like this, but I'm fairly certain that they had no idea this was coming. Given the surprise that all the other industry participants have had, but they have a very important role now, and they have a difficult role, right? If they're coming into this situation that, again, we have a lot of competing interests for what belongs to whom, and you have to figure that out before you make money move, or you start collecting, and then, as you said, basically it was lights out, which makes taking over an operations that much more difficult. So I'm certainly going to be watching the backup servicing angle from this on this situation very closely, because you need to have somebody in there who is knowledgeable, and can assume the very important responsibility of dialing for dollars and accounting for securitized cash flows with authority and confidence in a very short period of time. And time is even more of the essence, I would argue, in this situation, because you are dealing with borrowers who are more difficult to get a hold of as time passes, as we've
Right.
discussed, right?
And the ability to cure past due payments becomes
Mm-hmm.
diminished. One, two, three payments, and then and I think I had seen your podcast, and it was eerily prescient, some of the comments that they had made. It was almost as if they kind of, I know they didn't know at the time because it was well before this occurred, but I still don't know if they were hot, warm, or cold backup. Hot
Right.
meaning they're getting the tapes and they can step in. I got a sense that the backup servicer relationships was more of a cold backup. They've now, I think, been officially appointed backup servicer. I read somewhere a surprising and a positive sense. 99% of borrowers were making their payments electronically, which normally isn't surprising in this digital day and age, but with their borrower base, now if 99% of borrowers were making payments electronically, and those accounts have now been uh, turned over to Vervent, and those borrowers resume making those payments electronically. In theory, whatever has not been subject to fraud or double pledge, that so some amount of those payments could resume. Would you think, Bill? Pretty quickly. Uh, and I think they now have access to the building where the files are, and I don't know if they have access to all the electronic files. I haven't heard an update on that, but I think they're in the process of transitioning, and some of the stumbling blocks have been resolved, I think.
Yeah, look, I don't know either. I don't know whether they were hot, warm, or cold, and that could make all the difference. A best case scenario would be that they were brought in before the Chapter 7 and had some time to get their ducks in a row to assume servicing as quickly as possible. I haven't heard anything that makes me believe that occurred. So they're caught like everybody else to say, you are now the back. I think that was one of the things that Wilmington Trust, the trustee, determined, was that they appointed them the backup servicer in event of default had occurred. I think that would be in their part of their responsibility. I haven't gotten any indication one way or the other, good or bad, as to how well or how quickly the assumption of this role is going.
Yeah, I haven't heard. I think we're still TBD.
Right. And so still watching them, and still watching, of course, Wilmington Trust as they parse through the facts, coming fast and furious their way. I do believe that their role as not only trustee but as custodian for the ABS means that they are in physical possession of that chattel paper that I mentioned earlier, which is, again, a very important role of in the protection of ABS investors' first priority perfection and in interest in those assets. So I'll be watching for that fact to bubble up to the surface and confirm my understanding at this point as soon as they can. I hope we get some more facts in the official stream of reporting on this at some point. You mentioned something that caught my ear I didn't know about until recently, and this whole what was it called? Social bond
Social
issuance.
bond, yeah.
Maybe go into that a little bit of detail, because look, there's a lot of buzz around ESG green bonds and ESG bonds in general, or ESG ratings or ESG assessments. So environmental, social, and governance is the ESG there. And, that was coming to a head just a few years ago in the US. It has, and I think is still quite important and popular in Europe, more so than it ever has been in the US. It seems to have cooled off a little bit in the US. The demand for these assessments and ratings, but nonetheless, it is still certainly around and being looked at. What can you tell us about you said this was a social bond in this case. So what can
Yeah,
you tell us about that?
I don't know if I think at least one of their ABS was deemed to be a social bond, eligible for social bond, and therefore ESG investors can include it and label it social bonds. Social bonds go back, and I didn't mention it, or maybe I did. I used to work for a Bangladesh charity and looked at social bonds from that perspective. The first one I believe was done in Britain, looking at prisons reducing recidivism rate, and the bondholders would be paid off if the recidivism rate in prisons was reduced. So you align the incentive with the bondholders with achieving some social mission. In this case, because the borrowers were underserved, largely undocumented, percentage, at least half, let's say, up to 70% I've seen. Um, that's the serving the undocumented borrower is the social part of it, and I think the bond is just the ABS. I don't think that they've done a bond that is specific to, as my prior understanding of it, achieving a specific defined social mission. The loan was the social mission, the subprime auto loan, and as I said earlier, loans that default 50% shouldn't really be defined as a social bond. I think it's done to just kind of broaden the investor base. And I've seen some of the holders be the Calverts of the world who have a large presence in social mutual funds. So I think it was about sort of diversifying their distribution of the bonds rather than achieving a true social mission.
Right. So in this case, I mean, it it makes sense to me that they would qualify for social, for meeting the criteria for becoming a social bond, given their customer base, their target market, providing access to underserved, unbanked population by and large. I get that. That's a pretty broad mission by many different lenders and public policy officials. Um, I guess it's just a cautionary tale that that is call it a desirable aspect of a bond. But it doesn't speak to the credit, and just like any other, whether it had an ESG component to it or not, if I were the one investing, I wouldn't want to take on more credit risk without being compensated for it, just because it won in this case, social bond stamp of approval.
Your understanding is, I think, where we are today,
Mm-hmm.
maybe not where we were a few years ago. And you've heard about greenwashing. There's ESG laundering,
Right.
and companies, asset managers being sued for falsely labeling investments as ESG when they really weren't. So I think we're in a hold, and asset managers being sued by certain states for being too focused on ESG or DEI. So we're in a world of a different place in terms of social bonds. I work for a charity, so I come from it from very practical. Who are we helping? Are we really helping them? What's the risk to investors? And kind of I hope, a politically neutral place. And I've been skeptical of a lot of this stuff myself.
Gotcha. Okay, so let's move on from extrapolating from the Tricolor situation as we understand it, or as we don't understand it. In this case, how much, this is a question that I've been wrestling with as I watch this story unfold, is how much of this situation, this story, is idiosyncratic versus systemic? And you've touched on this a little bit earlier in our conversation, but let's really build that out a little bit. And I will tell you that I think it's a mix of both. If I had to weight it in my mind, I'm going to say it's mostly idiosyncratic. I don't think we're going to see a large wave of Chapter 7 filings across the industry. You mentioned there might be a cooling off of, warehouse lending, at least in volume, or maybe more scrutiny around those lending arrangements, particularly around the operational aspects to mitigate the risk of double pledging, which probably isn't as pervasive when I talk about, probably isn't as pervasive to the auto lending sector as a whole, just because a lot of auto lenders don't depend nearly as much as Tricolor does or did on wholesale arrangements, warehouse arrangements. What are your thoughts there? Idiosyncratic or systemic?
Well, I agree with you to the extent that it's majority idiosyncratic, majority being over 50% idiosyncratic. I think vertically integrated plus the heavy emphasis and marketing of undocumented and the concentration in Texas, single owner, private, although uh, they were actually majority owned by, I think, BlackRock and others. So should have been a positive. But I've seen a number of elements that overlap other smaller subprime lenders that are cause for concern. Like somebody like a LendBuzz I've been looking into, and they don't, even worst case, they don't appear to have as close anywhere close to the undocumented, although they don't specify it. They do have some exposure. Their FICO scores are much higher. They don't have their own dealer network. So I look at all that. I'm like, LendBuzz is kind of in the same, has some risks, but they have their own independent risks that cause me concern. Their relationship with their dealer network. They were relying on, I think, some amount of dealer guarantees to reduce their losses historically. That dealer guarantee is now diminished. So you can look at each subprime lender and say they share maybe 20% with Tricolor. Nobody is more than 50%, but they have their own risks. And the industry itself, just the fact that I say 60%, maybe 70 is idiosyncratic to Tricolor, doesn't mean there's not a whole host of other issues facing the subprime auto lending in general. But in general, I agree with you. I think there's a number of unique factors to Tricolor that makes it likely we're not going to see wholesale collapsing into uh, uh, Chapter 7s. But the tightening of the warehouse lines themselves, remember, these things collapse when somebody discovers it. First Brands, which happened at the same time, collapsed into Chapter 7. Their bonds were trading at par. Chapter
Was it?
11.
Sorry, that was Chapter 11, right?
Chapter 11, sorry, yeah. They were trading at par. Bonds are now trading at 30, senior bonds. How did they get found out? Well, they were doing a refinance, and one of the lenders says, we want to do a quality of earnings report.
Mm.
Well, they failed that quality of earnings report, and then I think a month or two later, they collapsed into bankruptcy. So tightening of due diligence on warehouse lending itself can reveal that the double pledging, triple pledging that happened at Tricolor and similar looks like it was happening at First Brands may be happening in other warehouse lines. Once they discover that, what do? They have to shut down that warehouse line. They have to terminate that line, which hits the credit of that lender, which could shut down that auto lender. So there's a cascading effect, even if it's not similar to Tricolor. The mere tightening and increase of due diligence on auto warehouse lines could cause a reduction or contraction in credit that could cause some of those smaller players to have a lot more trouble. And we saw, CarMax, which is vertically integrated, which shares that with Tricolor, their stock price dropped 20% in one day, largely on the back of a significant increase in auto loan losses.
Mm-hmm.
So, you can find each of these auto ABS players have some risks that overlap with Tricolor, whether it's vertically integrated, whether it's the weaker subprime, undocumented, but nobody shares enough of the elements of Tricolor to say, oh, that they're exactly like that. That's
Yeah, I would agree. Look, I think you mentioned LendBuzz, you mentioned CarMax. I do think that these are horses of a different color relative to Tricolor. They have many, I would argue, positive differentiators. But I agree with you. I think your point is dead on. You're going to see what the implications of this aren't going to be tomorrow, but with the passage of time, as these warehouse lines come due, certainly before they come due, you can imagine the risk departments of those banks are going to say, should we have this much exposure? Should we be charging more? Should we be having this relationship at all? And by the way, we're going to be sending a team of experts and really kicking the tires very, very hard, to stick with the auto metaphor.
and you'll see, if you look at all these warehouse lines, why are they making the lines? The lines probably are profitable on their own, but they're also most of the lenders, not all of them, are involved in the securitization, the banking side of things. So, harkening back to Glass-Steagall, where you separated banking from Wall Street operations, some of the banks might say, well, we need to ensure that the banking side isn't causing us to lend money, and not just subprime auto. This is across Wall Street. All whether it's private credit is probably a much bigger risk. Look at the relationship between lending to companies that you're providing banking services for, and the lending is your entree in order to win the banking business.
Uh-huh.
So if the lending business is putting you more at risk than you're going to earn on the banking side, they're going to say, well, wait a minute. Or if the lenders themselves don't have as much power as the bankers, they're going to be looking at the dynamics of the profit and loss between the profit between the lending side, the investment banking side, and whether that isn't presenting a risk to the system.
The other X factor here that could accelerate or decelerate this knock-on effect of Tricolor is, of course, and is out of the hands of, most people, is the economy, right? And I'm not going to look deeply into my very cloudy crystal ball at this moment, but I mean, as I mentioned earlier, there's a lot of momentum, years-long momentum of deterioration going on, which is particularly pronounced among the cohort of subprime borrowers in auto space and other consumer credit spaces as well. And if this continues, it continues to worsen. We're going to see more duress, more pressure on the system, and not everyone is going to make it. Not everyone is going to make it, right? And so we can expect maybe not more situations exactly like this, but more situations that are ugly.
Your point is extremely valid, and especially if you look at just take the average consumer. They not only have a car loan they have to pay, they have to have car insurance. Well, what's happening with car insurance? Car insurance inflation is extremely high.
Yep.
Well, if they don't have a full-time job that provides healthcare like me, they're probably on Affordable Care Act or a local state health exchange. Those insurance, regardless of what's happening with the budget talk, those, and I've seen it myself, those payments are going to go up 10-20% next year. So you take your auto insurance, your home insurance, your health insurance, and you've got inflation across other parts of your consumer basket. That's all putting pressure on that ability to pay that auto loan. And you now have, for millions of borrowers, I wrote about this, student loan repayments resuming and reporting to credit bureaus. So you have a large swath of the consumer base see their credit scores drop because they're now getting the student loans reported, and they're having to repay it and face garnishment of wages. I'm not saying right or wrong policies. I think both administrations had wrong-headed policies on student loans. That's a massive shock to the consumer
Mm-hmm.
across. And those student loan borrowers don't just have student loans; they have mortgages, credit cards. Buy now, pay later is another area of consumer indebtedness, and auto loans. So I think it's very important, as you said, to look at the economic circumstances facing the consumer, particularly those who are already stretched or stressed, like subprime auto borrowers.
Yep. Yep. I think that's well said. Rod, this has been a great conversation. I don't want I want to just open it up. Have we left anything out of the conversation that you think is really important kind of point to make, or have we covered it all? Any other thoughts before we wrap it up here?
No, I think we actually covered uh, pleasantly a lot more than I thought we would get to cover. So I think we covered. I had a bunch of topics that I wanted to cover. I'm like, I'm not going to get to all of them, but I think we actually covered those, and then a few other points I wasn't expecting to make. So I appreciate the free flowing platform and dialogue stuff. But I think we covered everything.
Likewise. No, it's been a real pleasure speaking to you and having just a frank and open conversation around a situation that is still unfolding. It's times like these where a lot of people clam up, honestly. Having said that, I know there's a significant demand for having conversations like this in real time. So I do appreciate you coming on to the podcast and having a conversation. And I suspect we're going to be on again. I hope you don't mind, because another month passes or whatever the time period is, and we're going to have probably a whole new set of facts to work with, and hopefully some of our worst fears will not have been realized, and we'll be able to clarify and correct where, our speculation was off course during this conversation. So
Look forward
really
to
appreciate it.
a follow-up. And I encourage everyone to check out your other podcasts, but especially the one with Vervent as being the most relevant. And they're not just a backup servicer; they're a backup servicer for a number of subprime auto lenders. I've seen Vervent pop up in a number of cases, so I think they're an important player to keep your eye on as a situation flows. And your podcast, I think, covered a lot of the critical territory on.
Well, thank you for that, Rod.
Sure.
Thank you very much for
Sure.
joining me today. And listeners, thank you very much for hanging in there. I hope you learned something, and we'll be back again with another podcast, hopefully with Rod on this topic or any number of topics, but do stay tuned. Thank you very much.
Take care. Thanks again, Will. Bye-bye.
Thanks. Bye-bye.